Algorithmic trading, revolutionizing the financial markets. Algorithmic trading, also known as algo trading or automated trading, has transformed the landscape of financial markets in recent years. This innovative approach utilizes complex algorithms and high-speed computer systems to execute trading orders, replacing traditional human decision-making. Algorithmic trading has gained immense popularity due to its potential to enhance trading efficiency, reduce transaction costs, and exploit market opportunities. In this video, we explore the concept of algorithmic trading, its benefits and challenges, and the future prospects of this rapidly evolving field. Algorithmic trading involves the use of pre-programmed instructions to automatically execute trading orders in financial markets. These instructions are based on a wide range of factors, such as price, timing, volume, and mathematical models. By leveraging vast amounts of historical and real-time market data, algorithms can identify patterns, trends, and market inefficiencies that human traders may not be able to detect. Benefits of algorithmic trading. One of the key advantages of algorithmic trading is the remarkable increase in trading efficiency it offers compared to traditional trading approaches. The automated nature of algorithmic trading enables faster execution of trades. Algorithms can analyze market data, identify trading opportunities, and execute trades in a matter of milliseconds. This rapid execution ensures that market participants can take advantage of time-sensitive opportunities, such as price discrepancies or arbitrage opportunities, which may exist for only a brief period. In fast-moving markets, where prices can change rapidly, the speed of algorithmic trading is a significant advantage. By automating the trading process, algorithmic trading eliminates the need for manual intervention, reducing the potential for human error. Human traders may make mistakes due to factors such as fatigue, distractions, or miscalculations. In contrast, algorithms operate based on predefined rules and algorithms, ensuring consistent and accurate execution without the influence of human fallibility. This eradication of human error results in more reliable and error-free trading operations. In addition to reducing human error, algorithmic trading also minimizes the impact of emotional biases on decision-making. Emotional biases, such as fear, greed, or overconfidence, can cloud judgment and lead to irrational trading decisions. These biases are inherent in human traders and can have a detrimental effect on their trading performance. By removing the emotional element from the decision-making process, algorithmic trading promotes objective and rational trading strategies. Algorithmic trading systems can process vast amounts of data and execute trades based on complex mathematical models. By analyzing historical and real-time market data, algorithms can identify patterns, trends, and market inefficiencies that may not be discernible to human traders. This data-driven approach reduces missed opportunities. By leveraging advanced mathematical models and real-time market data, algorithms can dynamically adjust trading decisions to manage risk effectively. Algorithmic trading provides the opportunity to execute trades across multiple markets simultaneously, diversifying portfolios and spreading risk. Market participants can access various financial markets, including stocks, bonds, commodities, and currencies concurrently. This diversification helps to reduce the exposure to any single market or asset class, thereby mitigating risk. Therefore, algorithmic trading enhances portfolio resilience and minimizes the impact of adverse market movements in a particular sector or asset. Algorithmic trading plays a significant role in contributing to market liquidity by providing a continuous flow of buy and sell orders. This constant stream of trading activity helps to narrow bid-ask spreads, which are the differences between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. By reducing these spreads, algorithmic trading enhances price discovery, facilitating the efficient matching of buyers and sellers in the market. Challenges and concerns. Developing robust algorithms for trading requires a combination of advanced mathematical models, statistical analysis, and programming expertise. The process begins with formulating mathematical models that capture market dynamics and factors influencing trading decisions. These models are then refined through rigorous statistical analysis to ensure their accuracy and effectiveness in real-world scenarios. Programming expertise is crucial to translate these mathematical models into algorithmic code that can execute trades automatically. This involves implementing efficient algorithms, optimizing execution speed, and integrating data feeds from various sources. Additionally, programmers must consider factors such as risk management, order routing, and compliance with regulatory requirements. Ensuring algorithmic reliability is of utmost importance to maintain smooth trading operations. System glitches or technical failures can have severe consequences, leading to financial losses or disruptions in market functioning. Rigorous testing and quality assurance procedures are employed to identify and rectify potential flaws in the algorithmic code. This includes simulating various market conditions, stress testing the algorithms, and performing backtesting to validate their performance using historical data. Continuous monitoring and surveillance are essential to detect any anomalies or deviations in algorithmic trading systems. Real-time monitoring helps identify potential issues promptly, allowing for swift corrective actions to be taken. Additionally, redundancy measures, such as backup systems and fail-safe mechanisms, are implemented to ensure uninterrupted trading operations, even in the event of unexpected failures. Algorithmic trading poses significant regulatory challenges due to its rapid and automated nature, which can give rise to concerns regarding market manipulation, unfair advantages, and systemic risks. To address these concerns, regulators must establish appropriate frameworks and measures to monitor and regulate algorithmic trading activities effectively. One key area of focus for regulators is the prevention of market manipulation. The speed and volume at which algorithmic trades are executed can potentially be exploited for manipulative purposes, such as creating artificial price movements or engaging in illegal trading activities. Regulators need to develop robust surveillance systems that can detect and investigate suspicious trading patterns, as well as establish clear guidelines and penalties to deter manipulative practices. Ensuring a level playing field and avoiding unfair advantages is another critical aspect of regulating algorithmic trading. Some market participants may have access to advanced technology or proprietary algorithms that give them an unfair advantage over others. Regulators must establish rules and safeguards to promote fair competition and equal access to market data and trading opportunities. This may involve implementing measures such as order precedence rules, market data dissemination protocols, and limitations on certain trading strategies. Algorithmic trading decisions can have far-reaching consequences, extending beyond individual trades to impact market integrity. It is crucial to ensure that algorithms are designed and operated ethically to prevent unintended biases or discriminatory practices. Ethical considerations in algorithmic trading encompass multiple dimensions. First and foremost is the need to prevent biases in algorithmic decision-making. Algorithms are designed based on historical data and patterns, which can inadvertently embed biases present in the data. Without proper checks and balances, these biases can perpetuate discriminatory outcomes, reinforcing social inequalities or unfairly favoring certain market participants. It is essential to implement mechanisms to identify, address, and mitigate such biases throughout the algorithmic development process. Transparency is another critical aspect of ethical algorithmic trading. Market participants should have access to clear information about the algorithms used, including their underlying logic and factors considered in decision-making. Transparent algorithms help promote trust and enable market participants to assess the fairness of the trading processes. Openness also allows for independent scrutiny and auditing to ensure compliance with regulatory requirements and ethical standards. Future prospects. The integration of artificial intelligence and machine learning techniques into algorithmic trading holds immense potential. Financial markets generate an enormous amount of information in various formats, including news articles, social media feeds, earnings reports, and historical market data. Analyzing this data manually is an arduous and time-consuming task for human traders. However, AI algorithms can quickly and accurately process these diverse data sources, extracting valuable insights and making predictions based on the patterns and trends they identify. This enables traders to make more informed decisions and take advantage of opportunities that might otherwise go unnoticed. By harnessing these cutting-edge advancements, algorithmic trading strategies can be significantly enhanced, risk management can be improved, and intricate patterns and correlations within the market can be identified with greater precision. Algorithmic trading has predominantly been used in equity markets. However, there is a growing trend of applying algorithmic strategies to other asset classes, such as foreign exchange, commodities, fixed income, and cryptocurrencies. Forex markets have seen a significant growth in algorithmic trading activity. The Forex market is the largest and most liquid financial market globally, with trillions of dollars traded daily. The decentralized nature of Forex trading, combined with its 24-hour availability, makes it well-suited for algorithmic trading. The use of algorithmic strategies in Forex trading can help optimize execution, enhance liquidity provision, and exploit short-term market inefficiencies. As algorithmic trading techniques evolve and adapt to specific market characteristics, it is likely that algorithmic trading will continue to expand into these asset classes. As you can see, algorithmic trading has revolutionized the financial markets, offering numerous benefits in terms of efficiency, cost reduction, and risk management. However, it also presents challenges related to complexity, regulation, market fragmentation, and ethics. The impact of algorithmic trading on market dynamics, such as the rise of high-frequency trading and changes in market microstructures, cannot be overlooked. As the field continues to evolve, advancements in AI and machine learning, expansion into new asset classes, the development of ethical and regulatory frameworks, and robust risk management practices will shape the future of algorithmic trading. It is crucial to strike a balance between innovation and market integrity, to harness the full potential of algorithmic trading while ensuring fair and transparent financial markets. Thanks for watching. We hope you've enjoyed the video, and if you feel we've earned it, consider subscribing to our channel. We'll see you soon for a brand new video.